Index-linked bonds. Index-linked bonds tie interest or principal payments to a specified index. In this case, will be inflation link, will be the inflation rate. In this case, could be the CPI index. So unlike standard bonds with fixed payments, whose purchasing power erodes with inflation, inflation-linked bonds provide cash flows adjusted for inflation. Most bonds are issued by sovereign governments, exemplified by Treasury Inflation-Protected Security, or TIPS, in the US, meeting investors' demand for inflation index returns. One of the things about bond is that, so bondholders, they worry about inflation other than counterparty risk. They worry about inflation the most. And why is that the reason? Because for fixed coupon rate, inflation would eat into your coupon rate, right? Because if, for example, as we see earlier example, 3.2% is the interest, and if inflation goes higher, your 3.2%, your real return will become lower, right? Because inflation goes up higher. There's a misconception that inflation is bad for bondholders. It is only inflation that is not expected that is bad for bondholders, because when coming out with the interest rate, it has already incorporated inflation into the picture. That means expected inflation has already been incorporated into the calculation of the coupon rate. So it's not right to say that, oh, inflation will eventually help me if I'm a borrower, because it would reduce my real debt payments in the future. But that's not true, because the interest rate has already incorporated the expected inflation part. It's only when inflation is more than expected, and that will be the part that would affect the borrower. Because if inflation were to be less higher than expected, you're actually paying more in terms of interest rate, because that has already incorporated the expected inflation into it. So, for example, if the inflation is very high, your interest rate will be high for your bond payments, because it needs to account for the fact that inflation will be high in the future. Expected inflation means inflation in the future, because your bond payments are paying in the future, right? What you need to care about is expected inflation in the future. And if inflation comes out lower than expected, it means it benefits the issuer, because now they're getting back more interest payment, because accounting for a high inflation that didn't actually really happen. So it's not that simple. But for TIPS, these are government bonds. It's for investors they are worried about expected inflation that are different from what is being priced in the market now. So they tie it to the CPI index. But in this case, the expected inflation will not be factored into the interest rate, which means that the interest rate that is being paid is in fact lower. Because remember, I told you for normal bonds, expected inflation is already being factored into the price. But for TIPS, you don't need to factor that in, because it is already based on the CPI index, which means that they don't have to factor that into the calculation. Growing interest in inflation-linked emerging market bonds reflect investors' apprehension about high inflation. So normally, the ones that are being problematic are developing country, emerging market, where they have a persistent problem of having high inflation. And the reason why they have high inflation is because the central bank has been printing a lot of money, and that causes inflation to go high. This we will cover in the economics part of the series eventually, but this is a very complicated topic to talk about here. And if these bonds you adjust it for inflation, you can hedge against rising price. Okay, so we do an example in TIPS. The principal amount in this case will be 115 million. You have a semi-annual coupon of 1% per annum, which means that it's 0.5% or 50 basis point for each payment, and a time maturity of 9.5 years. So this is inflation protected. It's based on a change in the CPI for all urban consumers. And so the CPI is broken up into different categories, and so you need to be specific which one are you referring to. So this is the CPI for all urban consumers, and it's not seasonally adjusted. So this is based on I believe this is 6 months difference in the CPI. So for example, if this is in July, this will be in December. Or I think this is in June and this is in December. And then you take the percentage difference. So this is 6 months later versus 6 months before. And you see there's a 0.849% increase in prices. And then you will increase that on in the principal, and the interest will remain the same, but you will just calculate it from a higher principal amount, resulting in a higher interest payment. Next, we talk about zero coupon bonds. So for the bonds that I think so far we cover are all bullet bonds. So you pay fixed interest. If it's a semi-annual, you pay every 6 months. But a zero coupon bond, you only pay at the end of the maturity. You don't have any interim payments. And so these are also often called discount bonds because they are sold at below their face value when interest rates are positive. If it will be discount to par. Par is 100. You will buy it at a discount rate. Like for example, it's $98, and you get back. You pay 98 and you get back 100 at the end. So the investor return is solely the difference between the purchase price and the maturity value, so representing a cumulative interest. These bonds are commonly issued by governments for terms of less than 12 months. So most discount bonds are less than 12 months, which is less than a year. Anything more than a year will be just a regular bullet bond. But there are cases where zero coupon bonds are higher than 1 year. For certain investors, they prefer zero coupon bonds more than regular bonds because they will not have reinvestment risk. But then your credit risk will be higher. But if it's a government bond, it doesn't really matter because they have no credit risk. So they prefer a zero coupon bond because they don't have to worry about getting cash, interim cash, and having to reinvest those cash. And also that we will see in the future how to derive the zero coupon yield curve from the bootstrap method. Because right now, if you look at the yield curve that we see based on the market, those interest rates have interim coupon payments. So those are not exactly actual interest rate that is okay. So for example, if you look at a 2-year bond in the market right now, price in the market, they can buy and sell in the market. A 2-year bond will have interim coupon payments, for example, 6 months, a year, 1.5, and 2 years. So it's not reflective of the actual 2-year rate. If you want to have a zero coupon bond rate, then you will have to strip out all these coupon, which will show how it's been done. So that will be more the true 2-year rate because you don't have to worry about reinvestment. And you're able to do it what we call stripping interest or principal payments we will show how this will be done in the future. But so what this part is trying to say is that we can manufacture zero coupon bonds from regular bonds. Okay, for deferred coupon bonds do not pay interest for the initial few years, instead offering higher coupon payments later until maturity. So it's structured in such a way that for the first few periods, you do not pay coupon payments, but subsequent period, you'll pay higher coupon payments. For certain companies, they might, because of cash flows or various other reasons, they prefer not to pay coupon rates first. But as you can see, because you are getting back the coupon at a later date, you have to account for the credit risk as well, right? Which means that the credit risk will probably, the spread will probably be higher. Issuer of these bonds typically aim to conserve cash right after the bond issue. This is for operating businesses reason. And this often indicate lower credit quality, which means it will be a higher credit spread. For financing for project that wouldn't generate income until completion. So this is the thing that, okay, I want to borrow money to financial, for example, a certain project, and I only see the revenue in the future after the project construction is completed, right? Which means that I will ideally would not want to pay the payment in the near future, where I would prefer to pay it after I get the revenue in the future. So this is something like deferred coupon bonds is something like, you know, think of it instead of a zero coupon bond, which is you pay it right at the end, like zero coupon bonds, which is an extreme form of deferred coupon bond, which is you defer all the way to the end. These bonds are generally sold at a discount to par because the higher later coupons usually do not fully compensate for the lack of interest payment in the early period. Okay, so this is what it's trying to say here is that rather than increasing the interest rate at the end of the deferred coupon rates, you might structure it in such a way that the coupon rate is the same, just that you are getting it at deferred. But in order to compensate the lender, it will be a discount. It will be a discount bond, so you will not be priced at par, which means that you don't actually need to pay par value like 100 in order to lend out the money. You pay at a discount value, for example, 95, and you still get back 100 at the end, plus the coupon payments. All these will come out with a yield to maturity, which would be the theoretical interest rate. Callable bonds, we actually talked this ad nauseum at the beginning, so I'll probably just go through this very fast. So a callable bond, the right to redeem all part of the bond before its maturity date. So this is like a call option. Issuers typically prefer callable bonds. Okay, so remember this is the issuer because they can call back the bond at when the interest rate is lower, they call back the bond and then reissue the bond at a lower interest rate. You can refinance if the market interest rate decline, right? And fixed price calls allows the issuer to repurchase the bond at a predetermined price in the future. So this is like the strike price is fixed. You can purchase it at par or above par. But okay, so if they purchase it at a premium, even though it's priced at par, but if interest rate falls a lot, the price of the bond will go up, and it might go up very much, a lot more than the, like maybe if you say 101, which is a premium bond, but the price of the bond could be 105, but you're still able to buy 101. What it's saying here. It's a callable bond with the call provision that the issuer may redeem some or all of the notes on any business days before. Okay, this is just the same stuff. Starting 3 years after settlement as a percentage of the principal amount plus accrued interest. So the main part that we need to focus on is the percentage of the principal amount. You can see that the callable strike price is, and in the initial few years, is higher than subsequent years after settlement. I mean, in the later part. The reason why the strike price is higher in the initial few years is because the bondholders hasn't received the coupon yet. But as time progresses, they will have locked in the interest rate for a number of years, which is that they do not require the bond price to increase that much in order for the bonds to be called back. So the idea is if the interest rate fall, the bond price will go up, and the bondholders require the bond price to go up a lot higher in the initial few years before the issuer can call back the bonds. As time progresses, the price wouldn't have to go up as high for the bond to be called back, because by that time, the bondholders would already have locked in the interest rate for quite a number of years. Some bond features make whole call, where the issuer compensates investors to repurchase the bonds. This is different from a fixed price call, which we have been talking about, and is common among highly rated bond issues. Make-whole calls give issuers more flexibility to purchase debt compared to market purchases. Okay, the difference is make-whole calls would compensate the bondholders the remaining coupon payments discounted back to the present value. And the yield to maturity is of a comparable sovereign bond, which has a lower interest rate, and you will tack in a spread on top of it. So from the issuer's perspective, a make-whole call is very expensive because first you have to compensate the remaining interest coupon payments, and also you have to base it on the spread that's higher than the sovereign bond, well above the bond's current market price, which will result in a price that is higher than the current market price, rather than a fixed call price where you would just exercise based on what is the strike price of a call option. So to make it okay, to just simplify, for you to remember, just know that for a normal callable bond, it will be called back at a lower price rather than a make-whole call, which would be a higher price. And this is the reason why this is seldomly executed for callable bonds. Okay, now we move to putable bonds. A put provision allows bondholders to sell the bond back to the issuer at a predetermined price, usually at par on specified dates. This is where the bondholders can put the bond back to the issuer at par value. This would occur when the bond price would be lower than par, which means that the market interest rate is higher than the coupon interest rate, resulting in a lower bond price. But the bondholder is still able to sell it back at par, which is higher than the current price. So this is beneficial to the bondholders by ensuring a guaranteed selling price at redemption dates. And because of this, the coupon rate would be lower than an otherwise plain vanilla bond because it's beneficial to the bondholder. So in order to compensate the issuer can issue this at a lower coupon rate. If interest rate rise after issuance, causing bond prices to fall, bondholders can put the bond back to the issuer. Okay, this is the part that we know, and reinvest at higher rates. This is beneficial to the bondholders. The issuer then has to refinance the debt at a higher yield. This disadvantages the issuer. Due to the value of the put provision to bondholders, putable bonds are priced higher than similar non-putable bonds, resulting in a lower yield to compensate the issuer for put option, like what I have described earlier. Higher price means a lower yield. So you issue at a lower coupon rate, which would price the bond at a higher price. If the bond's yield to maturity is less than its coupon rate, making its price higher than the put price, the put feature is less valuable and the bond behaves like an option-free bond. So this is a case where the bond price is higher, and which is higher than the put strike price. So in this case, the put option is pretty much worthless. So it's just like an option-free bond. Whereas, however, if the bond's yield to maturity rises above the coupon rate, this is when the put option is in the money, and the put price acts as a price floor. Because of the put price, or the strike price will be higher than the current bond price, so you will not go lower than the put strike price. Okay, now let's move to the convertible bonds. We will see this as an example later. It will be clear. This conversion feature gains value as the issuer strike price increases. You can think of it in such a way that you would only convert the debt into an equity only if the share price increase. If it's not, then you will not do it, because you only do it when it's valuable to do it. Unlike callable and putable bonds, which involve early debt retirement, exercising the convertible features replaces the debt with equity. We'll see why this is the case. I mean, why you want to replace the debt with equity. The thing is, if you replace debt with equity, you're essentially diluting the existing shareholders' value because you're issuing more shares. And in this case, you're sacrificing, but you can guess the reason why you want to do it, right? Because you want a lower interest rate, which we would show later. Convertible debt is frequently utilized by growth companies, especially those with restricted cash flow to cover interest payments and repay principal. If they can choose, they would rather not do this, but because the fact is that they cash flow tight, and ideally they would choose not to spend the cash on paying interest and eventually repaying the principal. So by either lowering the interest rate or converting the interest payment into equity, they are able to borrow the money at the initial start of the company when they require cash the most. This company may opt to raise equity at a higher conversion price in the future. So what this is saying is that by the time when you have hit the conversion price, which is higher than the current stock price, you will be able to exchange the debt with lower number of shares. So this is beneficial to the company, issuer, as in they are actually raising capital at a higher price. Additionally, convertible bonds may incorporate additional features like a call provision, enabling issuers to curtail bond investor gains resulting from share price appreciation by redeeming bonds prematurely. So this is a convertible bond with a call option. This is saying that to prevent so what the issuer is trying to prevent is to dilute the existing number of shares. So even before the bondholders convert the bonds into equity, issuer will have called the bonds back. Okay, now we have this convertible bond as an example. Okay, this is a 1.25% ZTG Biotech 5-year convertible notes term sheet. Maturity date 5 years from settlement date unless the notes are redeemed earlier in the conversion. So this is when you do the conversion from debt into equity. So the company is borrowing euro 300 million, 1.25% fixed coupon to be paid annually. So this is an annual interest rate. You don't need to divide it by 2. So they pay it every year. Okay, the notes are an unsecured obligation. So this is the seniority, and rank pari passu with other unsecured debt. Pari passu means on equal footing, which is the same as other unsecured debt. An investor has its sole option the right to convert a portion or full sum of the principal amount, okay, at any time at the conversion price during the conversion period. So the investor is the bondholder. Current share price 28 euro per common share, and conversion price is euro 42. The thing that to note here is that the conversion price is a lot higher than the current share price. So you will only be able to, it makes sense for you to convert only when the share price is above 42, right? If not, you are paying a higher price than the current share price is. Okay, this is just the period when you can convert the convertible bond. The 1.25% annual coupon is significantly below the yield to maturity expected for a standard bond of the same maturity. Okay, so this one makes sense, right? The whole reason why the issuer wants to do a convertible bond, I mean, potentially sacrificing equity. It's because they want to lower their cost of borrowing. And because giving the bondholder an option to convert would be beneficial to the bondholder as well, which is why they're able to willing to accept a lower coupon rate. So bondholders are often in exchange for a conversion right. Okay, this is what I was saying before. Okay, you can convert at a share at a price of €42 per share, 50% premium. Yeah. So this premium is only this premium is actually beneficial from the perspective of the issuer. Then the stock price has to increase before you can convert. And by converting at a higher share price just means that whatever your debt is, converting at a higher share price, which is beneficial to the issuer, as I'm trying to say here. The conversion ratio indicates the number of common shares a bond can be converted into for a specified par value. So the convertible bond par value divided by the conversion price, that will be the conversion ratio. We will see why this is important. Okay, for example, the corporate bond is traded in euro 1,000 face value units. So 1,000 divided by 42, which is the conversion price. Remember, it was 28, I believe, right? 28, the current share price. Will give you a conversion rate of 23.81. And this conversion ratio indicates the number of common shares a bond can be converted for a specified par value. So the current share price is 35, which is less than the 42. The conversion value of 803.35 is lower than the face value. But when you are trying to see whether is it worth converting, it's not to compare with the face value or the par value, but to compare to the bond's current market value. If the conversion value is higher than the current market value, then that will mean that it's worth converting because the value is higher, right? But if it's not higher, it's in fact lower, you're better off keeping the bond and receiving the coupon rate. Convertible debt is frequently utilized by growth companies, especially those with restricted cash flows, to cover interest payment and repay principal. Okay, this is what we explained earlier. Companies may opt to raise equity at higher conversion price in the future. Okay, this is the part where as the equity goes up in price and it hits the conversion price, it means that we can exchange more debt at the price in the future. For example, at 42 conversion price, right? You can exchange $42 worth of debt, which is higher than the current price of 28. Additionally, convertible bonds often incorporate additional features like a call provision. Okay, this is the part that curtail bond investor gains. Okay, so this is what's trying to say here is that ideally, issuer does not want the bondholder to convert to equity because that would dilute the existing shareholders' equity. So they would add a call option to the convertible bond so that when interest rate would to go down, the bond price go up, and then they can call when it hits the strike price to call the bond back. And this is ideally going to happen before the share price actually hits the conversion price. You can imagine for the fact that right now, if they can call the bond back before the share price, so the share price will keep on, ideally in that situation, will keep on going up. But before it hits the conversion price, you can call the bond back if the bond is callable, in the sense that the interest rate is low enough and it hits the call strike price. This will have the benefit of preventing the bondholders from converting into debt into equity. But of course, the fact is that the callable bond will increase the coupon rate, while the convertible part will decrease the coupon rate. Okay, so what is a warrant? Some issuers may combine warrants with bonds, offering bondholder the right to purchase the issuer's stock at a fixed price until the warrant's expiration. Note that we're talking about buying the issuer's stock, and it's not about anything to do with the bond. So this is like adding a sweetener to the bond holders so that they will purchase it. The bond itself remains unaffected by the warrant exercise. So what that means that once you exercise the right to purchase the issuer stock, your bond itself is not affected. You still receive your coupon rate as per usual. Warrants can be a valuable addition to bonds, offering potential equity upside to investors while providing the issuer with a more attractive financing option. So of course, in this case, the whole reason why they're doing this is because the issuer is doing this because they can lower the cost of borrowing. So by offering this addition to the bonds, they lower the coupon rate. So from the investors' perspective, they might benefit from the stock price increase. And warrant is like an option, but now we're talking about option on the issuer's stock and not the bond itself. And the option worth is of value, which is why the issuer is selling this option to the bondholder, thereby lowering the cost. Okay, lastly, we will talk about the contingent convertible bonds, also known as COCOs. Contingent convertible bond, commonly referred to as COCO bond, is a type of debt instrument primarily issued by financial institutions, particularly banks. The reason why banks issue these bonds is because it helps to maintain adequate capital levels and provide a buffer in times of financial crisis. So what does it mean? So during 2008 financial crisis, there was the liquidity crunch, right? Banks weren't able to borrow money because all the other banks are afraid to lend out money. After the 2008 financial crisis, there are frameworks such as Basel III, which mandate higher capital buffer to ensure financial stability, which means that banks are now required to have more equity buffer just in case they have a liquidity crunch. They do not require the government to bail them out, as they have the capital to survive crisis. So let's see how this COCO helped. Upon the occurrence of a trigger event, so this is a case where the bank's capital adequacy ratio is problematic, COCO bonds can convert into a predetermined number of equity shares. If you see this is very similar to convertible bonds. But this is based on the trigger event rather than based on the share price. This improves the bank's capital adequacy ratio by increasing its equity base and reducing its debt obligation. So a bank's capital comprises of equity and debt. So now you're just switching from debt to equity. So this would improve the capital adequacy ratio, which according to the Basel III framework, banks are required to maintain a certain ratio. Instead of converting to equity, some COCO bonds are designed to undergo a write-down, partially or fully reducing the bank's debt obligation and effectively writing off some of the debt to absorb losses. This just means that the principal that is owed to the banks will be written down. As you can see from this, that this is highly disadvantaged the bondholders. So to compensate that, COCO bonds offer a higher interest rate. From the bondholders' perspective, they're betting on the fact that this trigger event will not happen, so they can enjoy the high interest rate without suffering from the either principal write-down or to convert to equity shares, because the fact is during financial crisis, the equity will be worth a lot less as well.